Hi, guys. Welcome to the eighth episode of WTW, the weekly trading wrap up, where we talk about the week in markets from a trader's perspective, what to focus on and what to ignore. So let's begin. Okay, action packed week. As you can see, we always start here with the S&P 500, the SPY, and this was the week of the 6th. This is being Monday, big down Tuesday, Wednesday. Thursday, we had an off day because of Jimmy Carter's funeral, so the markets are closed. And then Friday, the big non farm payrolls report came out. Okay, so as you can see, we popped up on Monday, gave up some gains, and then the rest of the week all the way down. The market is down from its highs. It's down about 5%. So it's a minor correction so far. Okay. So what, as always, we start with a macro. So what kind of macro news came out on Monday that is relevant? Well, we had the S&P Global Composite PMIs. They came in at 55.4 versus 54.9. So they're expanding. So the purchasing managers indexes for the S&P Global Composite is increasing. We don't really look at that one. We look at the ISM, as you know, if you've been following. We look at the ISM manufacturing and services, which, one of them will come out later this week, and we'll get to it now. We'll get to it later. But for now, we can just ignore this one, although it does support what the ISM manufacturing is telling us, which is that services is expanding, and the manufacturing sector, although it's still contracting, it's getting better as time goes by. So, why did the market pump on Monday? The main reason is because of Trump tariffs. I mean, you're going to hear this narrative going on throughout the whole, days, weeks, and months to come. And it has to do with China, Trump, and tariffs. Okay, so whenever you see that some piece of news says that the tariffs are going to be less than expected, boom, the market's going to rip. Okay, because it means less inflation. Okay, that's the prevailing narrative. Okay, so more inflation is bad. Markets are going to go down because we can't cut rates as fast as we thought. And less inflation, I guess it's good because everything's going to be hunky dory. Okay, so the market pumped on the expectation, or the rumor, I should say. It wasn't really a news article. It was a rumor that Trump is going to ease up on tariffs with China. But then Trump comes along and says, nope, I'm going to be tough on tariffs. And then the market tanks again. Goes back. Well, it doesn't tank. It goes back down and forms an indecision candle. Okay, so that's the action on Monday. No real macro news to speak of. But on Friday, we should mention that last Friday here, the 3rd, some news came out after market, and that MicroStrategy is raising more capital to buy more Bitcoin. This time it's raising $2 billion of preferred stock to buy Bitcoin. Okay, that's significant because last December, it raised $561 million on a convert. Okay, so this $2 billion raise of preferred stock, this isn't convertible stock, this is a preferred stock, but this is almost 4 times bigger than the other one. Okay, than the previous capital raise, and it's just going to start buying Bitcoin. So, looking at Bitcoin now, this is Monday. Okay, Bitcoin pumped on the news. Okay, because it was like extremely bullish for it. So it was pumping before, and it continued pumping. And I think there's going to be a bid under Bitcoin because of this Michael Saylor buying. However, as you can see, it tanks because, as we said from like step one, Bitcoin is a levered play on the market. So when the market goes down, as do all risk assets, and Bitcoin is the riskiest of the risk assets, so it will go down too. Okay, so even if Michael Saylor is buying, excuse me, even if Michael Saylor is buying, it's still going to go down if the market's weak. And we know that going back to SPY, the market was weak the whole week. Okay, So that's it for Monday. Tuesday, what came out? Why this big candle? What's going on? Well, first, the first couple of, it was due to more good news in the economy. A couple of important macro data points came out that we follow. Well, the ISM services came out, as we talked about. So what happened with the ISM services? It's this one. Okay, the ISM services came out, and it was at 54.1. Okay, versus 52.1 the previous week. The previous month, excuse me, not week. So it comes out on a monthly basis. So services are expanding at a faster rate. The services economy, which makes up the bulk of the US economy, is like 60-70% services, is perking up. So more good news. And on top of it, we had the JOLTs report, which is the job openings, and they came in at 8.098 million versus 7.839 million previously. So more job openings. So this goes to show you that the moment the market sees any good news that the economy is expanding, it gets freaked out because this is the prevailing narrative. Okay, before we continue, let's go back to the SPY and say, why did the market tank on Tuesday almost 1%, 1.1% on good news? The economy is getting better. Why? Well, because there's a prevailing narrative going on, and we should mention it, okay? The current market narrative is as follows. Step one, strong economic data or news leads to higher inflation expectations, which lead to less future rate cuts, which are bad for the stock and bond markets, which lead to lower stock and bond prices, sell everything. This is the narrative that's going on in the market right now. And the market is super sensitive to anything that has to do with inflation, which would force the Fed to not cut rates as fast. Is it correct? To me, it's very, I don't think it's correct because it's just one-sided, okay? Because this is just looking at the inflation expectations of a hot economy. So why would inflation expectations go up in a hot economy? Well, multiple reasons, but the main reason is that as businesses start selling their goods and services, people have more money, so they borrow, they spend, and they borrow more money from the banks, which creates a new credit cycle. So they spend that money, and then that's inflationary. Okay, so you're going to have a whole new credit cycle, and that picks up inflation. Okay, but they're forgetting that there's another side to this argument, and the other side of this argument is that yes, people will start spending money. There's going to be a credit cycle, and interest rates might have to stay relatively high. It's only at 4.2%, mind you, the short-term rate. Interest rates have to stay relatively high, but you also have more productivity. More goods are being sold into the economy, produced and sold. So that's deflationary. The more goods that you produce, it's a deflationary component in the economy. So you have two forces: the deflationary component of more goods pumped into the system, and the inflationary component of more credit creation and people spending. Which one dominates? You have no idea. We just know the inflation part of it. And the inflation part of it is in our face, but we don't see the production efficiencies and how much goods are being pumped into the economy to make it deflationary. We don't see that part, okay? We just see that, oh my God, inflation's going to go up. There's two sides to every coin, okay? And by the way, if you look at, the S&P 500, let's go to a monthly chart here. I want to go all the way back. I want to go all the way back to before the great financial crisis here. 2003, 4, 5, 6. If you see the market was rising, interest rates here were at 4, 5, 6% before it started crashing. So interest rates were rising and the market was rising. Okay, rising interest rates is a positive sign. It's telling you that the economy is doing good and the Fed wants to mitigate inflation because the economy is doing great. Okay, eventually it will lead to a crash, but the thing is that inflation here was muted because despite the fact that you had a thriving economy, and inflation was supposedly going up because there was a credit cycle, well, you had goods being pumped into the economy, which mitigated that. So the deflationary pressures overwhelmed the inflationary pressures, and we didn't have that much inflation. Okay, so that's what happens in an economy. Like, let's go back to to today. So that's what happens in the economy. You can't just look at one aspect of it. You have to look at everything, and you don't know. It's not that easy. It's not like inflation is going up, therefore bad. Fed won't cut rates. It's a good thing that the Fed doesn't cut rates. Okay, and even if it does cut, if it cuts rates in a slow fashion, it's very good for the economy. It adds even more fuel to it. So you have to get worried here when you see this. We will get worried here when the market really starts tanking. Really starts tanking. Okay, not this. This is still. I mean, it did break the recent uptrend here by breaking this. Oh, by the way, if you don't remember, these horizontal blue lines are technical levels that are important. Okay, so it did break below this level and close on Friday. Okay, however, every other level is intact. It's not a big drop. It's just a 5% drop. Normally speaking, in every bull market, you have regular 10% drops in the market, okay? I'm not saying it's going to get there, because as this was happening, we had extreme, like if you look at the fear ingredient index, which I like, we have extreme fear. Okay, we're already approaching extreme fear levels. And only when we're down 5%, okay? Can it go lower? Yeah, we can go to 575, 570, but at this point, we're going to be so oversold, you're going to massive snapback rally, okay? And an economy expanding is a good thing, okay? You don't need lower rates. I mean, it could help, but the rate at 4.2% and 3, 4, 5, these are normal rates in history, okay? The anomaly was when we had 0% rates in 2009 to 2019. That's an extreme anomaly. Normally, economies have 3, 4, 5% interest rates, okay? And they could survive and grow. Because you balance the good with the bad. You balance interest rates to mitigate inflation with a growing economy. It's a balancing act. So just to make sure to reiterate that the current market narrative is as follows. It's super, super focused on inflation and completely ignores everything else. Economic growth and the deflationary pressures of that. Okay? So that's what happened on Tuesday, okay? So that was the big thing. We still had the continuing battle between Xi and Trump on tariffs. So if that gets resolved nicely, inflation is going to be mitigated and the narrative will start switching. We have an economy growing. What other thing happened on Tuesday that is a little bit curious is that, well, before going on, let's just say that when you had that kind of good news, let's go to the Fedwatch Tool. We like to look at the Fedwatch Tool fairly frequently. With every piece of good news, inflation expectations go higher and rate cuts get smaller and smaller. I mean, we started, I think, in the summer of 2024, people thinking there would be 6 rate cuts in 25. We went down to 5, 4, 3, and now if you look at 2025, okay, we're right here, 4.25%. The majority, I think it's going to be only 1 rate cut in all. I went to December of 2025 here. So in all of 2025, there's a 40% chance of just 1 rate cut and like an outside shot of 2 cuts. So we have just 1 cut coming in down from 6, and the market is just 5% down from highs. You would think that going from 6 cuts to 1 cut, the market would be down 20%. All of this froth would be eliminated. No, it's not, because there's more to it than just one aspect. It's a multivariate equation. You can't just look at one thing, okay? And trust me, I'm not smart. I don't know, maybe you are, but I'm not smart enough to know and to juggle all that. I just go by what I see and where the trend is going. And there's no change in macro. There's no change in, maybe the only change is in inflation expectations. You can see it here. the 10-year break-evens. This is the 10-year break-even. This is the inflation, the inflation on a 10-year bond, okay? And yeah, since December, it's gone up, okay? And it went from, let's say, September of 2024. In the past 3-4 months, it's up. Inflation expectations were at 2%. Now they're at 2.39%, okay? Over a 10-year period, of course. So it's probably even higher in 5-year, but we always look at the 10-year for the, because we look at the U.S. 10-year bond, and this is what's attached to it. So yes, 2.39% inflation is okay. It's not on fire. I mean, it's still within this zone, but it was enough to push the U.S. 10-year rate from 3.6 to 4.76. Okay, which is a lot. And now we're past. We broke this downtrend when we broke above here, but now we're coming to this resistance point. And if you look, we are at the RSI here. We're at a very overbought. Okay, will it continue? Does it have more push? What more could happen to push inflation expectations even higher to do this? I don't see it. We're not printing any money. Okay, we're not doing any QE stimulus or whatever. So let's see how it goes. It might correct and it might go up again, but you're going into resistance. The narrative is super strong. Inflation bad for rates. Not for rates, for rate cuts. So we're down to one rate cut in 2025. Off chance of 2 rate cuts. Okay, so back to SPY, and that's the narrative, and that's why the market freaked out and tanked a lot. Okay. One thing that should be mentioned is that given all of this, what are the other proxies to inflation doing? I like to look at oil. And you can see this is oil on Friday today because there are sanctions from Russia. But oil is up over the course. Like if you look at the longer term view here, you see that we hit the support and it's going up, but we're still in a downtrend. Okay, we're still in a downtrend, and things are getting to the exhausted points. Okay, so we're still in a downtrend. This is a counter move in a general downtrend. So this adds to inflation expectation. Inflation going up, you can't have inflation without oil going up. It's impossible. So this recent action in oil, because it just happened in December 27th, so the past 2 weeks, you had oil move, okay? And that's what's fueling inflation expectations as well. And I like to look at copper, because copper is the metal of the economy. The economy uses copper. Okay, so when the economy is doing well, copper should do well. I mean, not necessarily, but if inflation is going up, copper should go up as well. And yes, we have the past 2 weeks, copper also going up. Okay, but still, it's still stuck in a sort of range. Okay, so back to SPY. We have the proxies for inflation going up to support the inflation narrative. Okay, but is that the only thing? We'll see. Okay, that was this big Tuesday candle, which was very important. Okay, it destroyed the upward move in SPY. It was where it was looking that it was going to break up, do a double bottom and break up. This week destroyed that view. So now let's go to Wednesday. This little green candle here that didn't do much. We had the ADP, which is employment, but private sector employment. It came at 122K. It was expecting 140K, so it was below expectations. So you have private payrolls going down. In November, it was 146. So the trend for private payrolls is down. Okay. And you'll see that the trend for non-farm payrolls is the opposite. It's going up or holding. Okay, we'll get to that on Friday. But now we're on Wednesday. Okay. So what came out on Wednesday usually comes out on Thursday, but it's the initial claims. We always look at initial claims. Okay. And initial claims came at 201,000. Okay, versus 211 expected. So initial claims are coming down every week. They're coming down. Okay, and as I mentioned before, you can tell, like, you take the past 4 weeks, you can see that as they're coming down, you can pretty much have an idea of what the job numbers will do on the first Friday of the month. Okay, because this comes out every week and the job numbers come out every month. So as initial claims are going down, that's telling you that the economy is getting stronger. People are not filing for unemployment. Okay, so you should have an idea that this gave you an idea that jobs would either hold or beat going forward. Okay, now they beat, we'll get to it, but I didn't expect they'd beat that much, but you can pretty much be not certain, but you have a good idea that the jobs report that's coming up will be fairly good based on the initial claims. Okay, so that's what we look at it, and we also look at continuing claims. Where are the continuing claims? Here, I'll just here. So the continuing claims went up, so that's not good. It's a little bit mixed. Went up to 1.87 million versus 1.83. It's okay. It's not that bad. So what we want to see is initial claims going down and these guys going down as well for a strong economy. Okay? And so we have a strong economy. We know that there's going to be the economy is doing much stronger than people have anticipated, and that's what's freaking people out because of inflation. Okay. What else happened in this little day that was sort of uneventful? Well, we had some news from NVIDIA's Jensen, the CEO. He started talking negatively about quantum computing stocks. It's a little sector in the economy that tends to heat up now and then. One of them is Enoch. No, sorry. This stock there. Quantum computing company. Okay. So he goes on, he goes quantum computing stocks on Wednesday. This is Wednesday. This is quantum computing. As you can see, quantum computer stocks have rips. Okay, let's go back even more. They had these spikes up occasionally. We had these spikes up, okay? You can go back even further. Let's go per month. Well, then you won't see it. Yeah, because of the... Yeah, you can't do it because of the dilution. They split. So let's go back to the day. As you can see, on occasion, these stocks rip. Okay, and they're just rip, and then they pump and dump. Okay, rip, dump, and this is dump. Why did it dump? Because Jensen said that quantum computing is 15 to 30 years away. It's not going to happen anytime soon. So boom, tank. It's over. These are pump and dump stocks. Okay, it reminds me of the meme stocks that people tend to pump and dump that are crappy, have no fundamentals, and these guys, they don't. They're just bleeding money. Okay, so stay away. I mean, if you want to play them, you could, but you have to get out on these pumps. It's very difficult to do. Trust me, it's very difficult to get out here when it's. Who gets out here after 3 moves higher? This is very bullish. You would think it'd go even higher. No, it starts consolidating. It's consolidating after a big move up on a triangle. It generally breaks to the upside. That's what technical analysts say. Nope. Because everything is driven by fundamentals. Okay. So Jensen destroyed the quantum computing thing, quantum computing bubble. Let's go back to SPY. Now let's go back. Well, Wednesday. Okay. Now let's come to Friday. Non-farm payrolls. Okay. Non-farm payrolls came out. 256,000, but they were expecting 165, so it blew out. It keeps blowing out expectations. Super bullish for the economy, super bearish for rate cuts, I should say. So chances of a rate cut now, like we showed you right here on the CME Fedwatch tool, for all of 2025, 1 rate cut probably. Maybe 2. 1 rate cut. That's what made this market go down. It opened up nicely. It held actually. And then it closed all the way down to destroy this technical pattern here. So we closed below the first support here. But we did so at heavy cost. Fuel, a lot of fuel. I mean, I've rarely seen this down to the 15 level. I've seen it a couple times. That's extreme fear. Okay, that's why we might go down to the 75 level here, maybe 70 to get to really extreme territory and get the, oh, by the way, the VIX hasn't exploded yet. It's just at around 1953. Maybe it gets to this level again. Like, let's draw it here. Maybe it gets to these levels. Maybe if it gets to 70, 75, that would be the ultimate bottom, in my view, before another 1 or 2 months of upside. Okay, so today broke Friday. I'm recording this on Friday, so whenever I say today, I mean Friday. So Friday, this is the Friday candle, ended at near lows, not really, but it broke this support level at heavy cost though. Let's see if it recaptures it in the next week to come. Okay, so the overall summary of what happened this week is reinforcement of the current market narrative. Inflation is picking up because of good economic news. All we had was good economic news. Good economic news equals bad news, I guess, for this market, for the stock market. Okay, so this narrative is being reinforced heavily, and I'm not sure it's true. I mean, you can't. It could be. I mean, you could have an economy that's strong, but inflation expectations or actual inflation, when it's realized, is much stronger than the deflationary forces of a strong economy. It's generally not the case, but it could happen. But the odds are that we are getting close to a bottom, we're working it out, and then we're going to snap back. Okay, that is my view. So that's it for this week, and looking forward to next week, especially to see if we see that play out, a drop and then up, or do we just gap up afterward? I don't know, but I have a feeling that we're getting very close to a low, and that the weeks to come will be bullish. So stay bullish.